Hey everyone, welcome back to Finance Flicks Hub, your go-to channel for real talk on the markets, what's actually moving them, and where the opportunities lie. I'm glad you're here. Right off the bat, the markets are wobbling, fear is creeping in, but that doesn't automatically mean disaster. Today we're going to dig into what's really going on, why this might be a rare buying opportunity, and which stocks I'm watching closely. We're going deep, so grab your coffee, stay tuned, and let's dive in. 1. Market snapshot. Where we stand right now, here's the live feed view. The S&P 500 is trading around 6,657. On November 18, 2025, down modestly from recent highs. U.S. stocks ended sharply lower on Monday, tech again leading the slide. Markets are clearly concerned. Declines across the tech sector, risk assets, and even crypto. Global equities are slipping, indicating a pullback in sentiment. So even though the overall pullback is not huge yet, the mood in the market is definitely shifting. 2. Correction versus crash. The difference matters now more than ever when markets dip. The big question is it a correction or a crash? A crash equals drop of approximately 20% or more. A correction equals typically approximately 10% to 20%. Historically, since 1950 gives only 10 true crashes versus 36 corrections. Since 1929 gives 56 declines of 10% plus, only 22 turned into full bear markets. So far this move doesn't qualify as a crash yet, which means the risk-reward dynamics shift toward buying opportunities. 3. What happens after corrections? Showing the potential upside. Look at the data. Buying during past corrections has paid off. After the last 9 corrections, the average 12-month return was about plus 18%. In 2023, when the market fell approximately 16% in about 2 months, guess what happened? The market soared approximately 41% the following year. Given we're seeing signs of a dip but not a full meltdown, this pattern suggests we might be in the early stage of a bigger bounce ahead. 4. What this dip could become. Setting realistic expectations. Based on past corrections, the average duration from peak to bottom, approximately 71 days, approximately 10 weeks, average drop, about 15%. Given that, the market could drift into 58,006,000 territory on the S&P if this correction runs its full course. And just like we saw earlier this year, tech and AI stocks tend to drop more sharply than the overall market. We're already seeing that. Tech heavyweights down more than the index. Risk assets globally under pressure. So yes, we could see more pain in growth stocks over the next few weeks. 5. Why I believe this is likely a correction, not a crash. Several key factors support that view. 5.1 Employment and economy unemployment remains moderate, approximately 4.3%, not at recession territory just yet. 5.2 Earnings strength. Last quarter, S&P 500 earnings rose approximately 13% versus approximately 8% expected. Tech profits grew approximately 27%. That kind of growth doesn't come from a declining economy. 5.3 Rate cuts in monetary policy. The Federal Reserve has already cut rates by approximately 1.5% this year. Markets are still debating when the next cut comes. The uncertainty is keeping volatility alive. 5.4 Global context and outlook. A major strategic note. Morgan Stanley just raised its 12-month target for the S&P to approximately 7,800, citing pro-growth policy, AI strength, and better earnings. This suggests institutional optimism remains, even amid the current pullback. Put it all together, and the data just doesn't look like a setup for a full-blown crash, more likely a meaningful pause, or correction, before the next leg. 6. Buy levels I'm watching on the S&P 500. Here are the tactical zones. Current S&P, approx. 6,650 region. 5% down, approximately 6,350 to 6,550. Gives start adding positions. 10% down, approximately 6,000 to 6,200. Gives time to get serious. Again, push your entries gradually and reserve some cash for deeper pullbacks. 7. The stocks I'm targeting 7.1 AI and infrastructure. SMCI Super Microcomputer. down approximately 30% this month. Great entry point if you're bullish on AI infrastructure. 7.2 Crypto and tokenization. Ethereum exposure trusts ETFs, stablecoin usage is doubling. Tokenization is accelerating, adding more exposure to projects tied to that trend. 7.3 Cybersecurity stocks. A long-term, unstoppable theme. I own and plan to add CRWD, CrowdStrike, FTNT, Fortinet, ZS, Scalar, PANW, Palo Alto Networks, OKTA, Okta. These companies offer structural growth, not just cyclical bounce-backs. 8. Stocks to watch in the near term. 8.1 VDA, NVIDIA, big earnings release ahead. Expectations very high, approximately plus 56% revenue, tilde plus 54% earnings. Guidance will matter more than the beat itself. 8.2 Palo Alto Networks, Panway. If its outlook is weak, the sector could drop, which might present a buying moment. 8.3 WMT, Walmart, reports soon. Only modest growth expected, approximately 4%, so decent chance to beat. Also interesting AI rollout on the horizon. 9. Sector landscape and broader themes. Energy and healthcare are currently holding up best. They may offer relative safety. Consumer staples are lagging, down approximately 1.7% this year. Gives could bounce if input costs fall or tariff pressures ease. Crypto and speculative tech are under pressure. Sentiment is shifting away from buy everything AI toward which companies will deliver. Volatility remains elevated. Options pricing suggests the market is expecting plus or minus 1.9% moves in the near term. 10. The big picture. The AI infrastructure supercycle. This is still one of the biggest structural stories in the market. Data center workloads projected to rise approximately 167% over the next 5 years. Energy demand of plus 137 gigawatts equals massive scale. 80 gigawatts of new data centers planned this year. Only approximately 10 GW under construction. Spending by big tech plus hyperscalers is already huge and committed for years. Even if valuations feel stretched today, the physical build-out timeline means demand will be locked in for years. This supports companies like NVIDIA, Supermicrocomputer, AMD, Broadcom. Any dip in these names is part of a long-term uptrend. Ending all right? That's a wrap for today's update. Remember, the headlines might be loud, but the fundamentals still point toward opportunity, not disaster. Corrections can feel uncomfortable, but history shows they're often where the smartest money gets to work. Thanks so much for watching Finance Flex Hub. If this video gave you clarity on the market's current move and helped you feel more confident in your strategy, hit that subscribe button so you never miss our weekly updates. We'll see you in the next one. Stay sharp, stay disciplined, and most of all, stay invested.